deficit. So for the year 2021, revised estimate is that you have a fiscal deficit of 9.5%, which is roughly about 18 trillion. You have primary deficit, which is after interest payments, of 5.9%. You can make out number. So 3.5% of GDP is your interest payments, and you have this revenue deficit of 7.5% for FY 2021. Next year projection is that from 9.5% of fiscal deficit you will go to 6.8% of fiscal deficit. From 7.5% of revenue deficit you will go to 5.1% of, and from 5.9% of primary deficit you will go to 3.1%. So this is the answer to the first question. Regarding how do you finance this level of fiscal deficit? So you have rightly said that the bulk of it will be debt, borrowing from market. So the borrowing number usually what we had over 5 year, previous 5 year period, excluding last year, was about 4.5 trillion. 4.5 lakh crore के आसपास जो market borrowing net level पे होती थी. Gross market borrowing was about 6.5 and 7 lakh crore, because part of the existing debt has to also be refinanced. So what government pays you back, you net it off. So the net market borrowing number was on a trend basis about 4 and 4.5 trillion. Now the trend has moved by somewhere around 5 trillion up. So 5 to 6 trillion new borrowing is happening. From where it will come? Of course, banks have to chip in, but banks were able to do because there were not many credit-worthy opportunities. So you invested into your GSEC. The major contribution which is going to come is from Reserve Bank of India, open market operations, OMO purchases. Last year, the current financial year, FY 2021, it has done more than 3 trillion, 3 lakh crore zyada kiya. And in last policy, governor made this very clear that they are going to do this, not less than this year, in FY 2022 also. So you can expect that 3 and 4 trillion somewhere, this number of borrowing will be financed by Reserve Bank of India directly through OMO. Of course, not directly via banks, because banks subscribe to government bonds and then banks sell these bonds to Reserve Bank of India in OMO. Ultimately, it ends up on the balance sheet of Reserve Bank of India. So of the increased 5.5 or 6 trillion number that we are looking to finance, 3 to 4 trillion will come from Reserve Bank of India. Balance of 3 trillion or 2.5 trillion that you are looking at is you have new players. Reserve Bank says that it is also opening to retail for subscription. How successful we will have to see. It is also saying that trying to list Government of India bonds to foreign markets, offshore markets, where foreign subscribers can do it. One way to do is that you make it part of index fund, where sovereign wealth funds can directly subscribe to these bonds. So you get foreign money subscribing your domestic fiscal deficit. Your external debt will go higher, but part of contribution will come from there. And the part of the deficit has to be financed through disinvestment revenues. Now, you rightly said that you hardly made 35,000 crore from disinvestment, and you are expecting this year that your receipts will be about 2 lakh crore. Then it all depends on what kind of assets you are putting on sale. The government says that LIC will be completed this year. You will have 2 banks which will be privatized this year. So whether they can do it is something to be debated, or something to be a matter of how much trust we have in the government to do what it talks. But the numbers are, I would say, fairly out. And it says that, this level, financing should not be an issue. For a bank, for a country which, borrows mostly domestically, more than 80% of borrowing is happening domestically. Domestic audience is a captive audience. If a bank, you get a call from DFS or RBI, your treasury guy can't say, no, I don't borrow. Still, when you have 3/4 of deposits with public sector banking. So I don't see there is a problem on that. Speaking of how much opportunity will be there for deposits, deposits are just a kind of the mirror image of credit. If credit picks up, automatically deposits get created in the system. Last year, why this contrast was there? Because credit was happening, it was not happening to the corporate. Credit was happening to the government. So whenever you invest in a Government of India security, actually you are lending your resources. Only party is different. The party is Government of India. So whosoever is receiving the money is receiving in some or other bank account, right? So it gets credited automatically to some other bank account. So your lending becomes deposit for somebody else. So it is more about whether lending will happen. And lending for this year is, I think it should be better than last year, because last year for 3 months your 60% of the system was not participating. This year you have hope that first government is leading through capex. Second, there is no restriction on the private sector. And third, that cost of borrowing is at historical low. 3 things together, you have all greenery out there to go and praise go. Next one, please.
Sujit, one question. Hello.
Yes, sir.
आवाज आ रही है?
Yes.
Just if I look at the numbers and the budget proposals, basically the budget highlights on the quality and the quantity of the capital expenditure. And one thing, a lot of incentives are being given, be it the PLI and other manufacturing focus or the export orientation. And if you look particularly where there's a concern going forward, is that there has been a cost push pressure in terms of inflation. Basically, there has been rise in the indirect taxes, be it the LPG or the cylinder or the custom duties. So that would be going forward inflationary, I suppose, to certain extent. I don't know to what extent, but it would be inflationary, and that would eventually raise the cost of borrowing for the government. And given that the huge borrowing requirements are there, so how would that be? Is that going to be counterproductive? It would derail the borrowing program of the government, or do you think there is scope for
I think that is the dilemma. That is the dilemma dealer is living with today. Because government says that it wants cost of borrowing to be low. Reserve Bank says that yes, we will ensure it, but then market says that you were expecting 6.1, you are indicating 6.25, and it can actually run up to 6.5 if you look at the 8-year maturity and 12 or 11-year maturity. Both are trending somewhere around 6 and 6.6, 6.7. So only 10-year maturity you are trading in 6.25 or 6.2. So the indication is that yields are going out of bound. Right. So of course, it is a derivative of market's confidence in whether the inflation number will be as per the projections of Reserve Bank of India, whether the government will actually borrow what it is telling you. Because last year, what it said, in February, it comes with a revised estimate and it says that it will borrow 80,000 crore more. So it's all about how much trust you have in the people who are speaking out there. Yes.
Okay, two more questions. Basically, I want to know. One is about the operation twist, the simultaneous sale and purchase of the government securities on the OMO purchases by the RBI. How that is it in terms of reducing the short-term cost and taking it longer, or is there something else in this thing operation twist? I'm not having clear idea as of now. And second thing, yeah.
Please continue.
Yeah, and second question is related to what are the developments that the RBI or the government is taking to further develop the corporate bond market? A few pointers just.
Perfect. The first thing first, speaking of OMO, see, there are two things. One is operation twist, you have rightly said. This is the word which is being practiced now. And the one is about switching of securities. The switching of securities usually happens to, elongate the maturity, right? Let's say you have borrowed in 2010 for a 10-year period and it matures in 2020. So if you are in 2019, you're obviously pressed that in 2020 you have to pay the face value of it. You don't want to pay, you borrow for another period and substitute this debt. So that is switching of security. Only for term switching it is happening. But operation twist is not about that one. Operation twist is about that you want to change the yield curve, the cost of borrowing in near term and cost of borrowing in long term. That is what you want to change. So usually what happens, you have a rising yield curve where for near term borrowing you pay less, for a longer maturity you pay a little higher. But then since longer maturity is what is the anchor price for market borrowing, corporate borrowing, government can't afford to let long end of curve go ahead. Especially 50 to 60% of borrowing happens at the 10-year maturity. So what they are doing is that they are selling securities at a short end and borrowing at the long. That way, they are creating additional demand for long maturity papers. If there is a more demand, the price of those papers will go up and yields will come down. Right? So the bond yields for a longer maturity period will come down. Instead of rising curve, you have a curve where the short end kind of elevates and long end kind of comes down. So that is the twist that we are witnessing. This has been practiced everywhere across the globe. Major central banks have been mastered this art. In India also, this is what is being happening. You have an unfortunate situation. You are overnight money market is about 3.3%, and 10-year you are borrowing at 6.3%. So you have a 3 percentage points of difference. And this is. But
I'm still not clear one thing about that you said. In the shorter end, they are going to steepen the short end curve and somewhat likely flatten the long end curve of the yield curve, right? So, given the current market borrowing program of the government, if you are just going to steepen the short end of the yield curve, that would raise again your cost of borrowing and higher payment obligations.
Exactly. But what is happening here
then what's the benefit?
No, the benefit is not just about the government. The benefit is about the overall market. Because when you look at the market, CDs, for example, corporate debentures. Mostly they raise for 10 years paper. So CDs are incurred to what? 10-year GSEC. So if 10-year GSEC goes up, CDs will go up. Right? So if you have to look at the overall cost of borrowing in market financing in the country, then the long end is what matters. Short end, of course.
Okay. And about the market initiatives taken.
About the second question, how to develop the bond market. See, bond market has three requirements. One is that you should have sufficient issuers in the market, right? People who would like to borrow from general public. The second is that whatever is being issued should be liquid, it should be tradable, right? And the third one is that there should be certainty, right? The credit cost should come down and the cost of borrowing should come down overall. And all three aspects are kind of, interrelated. You have a system, such a skewed system that where, top 500 corporates have, account for more than, I would say, 80%, share of market cap. And that is the same picture happening in the debt market also. So you need to diversify. Within top 500, if you look at the AAA and AA, that's where the cream is. All that, secondary market activity is limited to what? AAA and AA papers. So if you want to have a diversified pool, you have more number of players. You have to have a larger share of pie. What government this time is doing is that they have announced that they are setting up development finance institution, for example. Now DFI, we have been well versed with DFI. It started from 1960s. It worked till 2000, and that did its job very well in terms of infra development. In the interim, what happened post 1990, when you have new private sector banks coming in, and this whole idea of giving the control back to markets rather than government doing its talking. So you have a situation where the DFIs lost their privileged access to deposits. So they had a long-term bond which was SLR exempted, right? SLR eligible, and which made them a primary kind of security for players who are looking to have a kind of higher yielding paper in their book. So over the time, that since that privilege was lost, their competitiveness came down, and the banks themselves started doing aggressively, because in foreign markets, when cost of borrowing came down significantly after 2003, that boom was there, where you could borrow cheaply compared to Indian this became unviable. First of all, there were no takers of your money. Instead of borrowing from DFI, they could borrow overseas from directly. And second is that on the financing part, banks were not interested, or other financial institutions were not interested to give money to DFIs, so they lost their relevance. Now what you are discovering, that banks have perhaps gone overboard. 15-16% of your scheduled commercial banks book is actually investment lent to infrastructure. Infrastructure has its own issue. You have LM issues. Your funding profile is short maturity. You are lending for a longer term. You get stuck. When a project gets stuck, you get stuck. You have more NPS. You can't exit. Takeout financing market is not there. What I second told. You need to have liquidity. Once somebody is issued a debt, I am holding that debt. If I am in current situation, where do I go? Because this will be serviced after the maturity. If 10-year paper is there, then 10 year after 10 year, I will get my principal back. In the meantime, what do? I need to sell it to somebody else. But somebody else is not ready to take this paper. This is debt for me. And this is what prevents me from taking exposure to these papers. So you need to have secondary market active for a very functional primary debt market. That's the idea. And this development finance institution, which is being announced today, it's kind of 20,000 crore budget has been allocated. The plan is that existing IFCL जो है उसका भी capital merge कर देंगे, develop 30,000 crore of capital, and if you take leverage of about 15 times, so they can finance up to let's say 5 trillion kind of things number. So 5 trillion of loan can happen to these things. But banks have to be prepared, because banks are also kind of contending for the same market. So whether you want to be similarly aggressive with them, you would rather not to have that burden, because you have already burnt your fingers, that the call has to be taken from banks. And that would be a very good question actually. Now with DFI is coming out, a large bank, corporate bank taking the Bank of India sees its play. That could be a good question. Second, I am getting from chat window is a question about ARC. Right. So it's about government has also said that they are setting up a bad bank, and that bad bank is unique because in India you already have 27, 28 ARCs, asset reconstruction companies, which are kind of experts at resolution of bad assets. So there are three ways to manage bad assets. One, you do on your own. You use your all prowess skills to bring back the party on negotiating table and settle over the counter. if that doesn't happen, you sue them, you take them to the court, and if you have court, DRTs and NCLTs after insolvency and bankruptcy court came in. These are two means which bankers have been quite familiar with. Now, the third dimension is about, you exit from the exposure. You let it be somebody else at it. So you have a private ecosystem there in terms of, asset reconstruction companies, ARCs, which says that, you said sell the asset to me, and you keep part of stake in terms of, equity, and part of will be released to cash, so what you call security receipt. And whenever resolution happens, you get benefit out of it, but then it didn't work for a variety of reasons. Now government is coming on with a new setup, which says that, okay, it will be a public sector funded ARC, and it will manage the bad debts. The idea for having a public sector ARC is important, because what is happening is that this time you have assets which are having a very long gestation. That's the power sector assets. You build capacity thinking that India will grow leaps and bounds in 15 years time. This kind of power deficit is going to be there. So you need to have kind of investments to meet that kind of energy demand. And when you build those capacity, you found that there were not so many takers. India did not need that many units of power. So you have a standard capacity, and meanwhile many things change. Commodity cycle turned, renewables came up. So the cost of producing power came down significantly. These farms which were founded with a given objective, they become kind of non-competitive players in the market. When renewable quotes you at less than 2 rupees. So what is happening? How will it work? You have the ARC, which is funded by public sector. The difference is that this ARC will have also AMC, and ARC is kind of just a balance sheet adjustment where you have the security sold to ARC, right? Now ARC gets capital from whom? Sponsored banks. Let's say 700 banks come together, they contribute 5,000 crore rupees, and those 5,000 crore rupees has to be paid back to banks. Right? So when this cash transaction happens, 85% is paid as security receipt, so you have the interest, and 15% as cash. So now that most of the banks have made the provision more than 85% for the key assets, the infra assets that I'm talking about, power assets specifically. Because the assumption is, if time permits, these assets will become viable, because India, having a demography and GDP, over the time, yes, you will need more power, but right now it is not viable. So you have to give time to it. But if you keep the debt meter clicking, the projects will never become viable financially. Even if it is economically productive, financially it will be unviable to take. But these are national assets. The money invested there, the capital plant in machinery put there, these are national assets. You can't let them rot. So you have to keep this productive, you keep this functioning. And what better thing to do than manage through nationalization? Now they don't want to do it old style way of nationalization. Government just buys it out and keeps it. It does it via medium. That via medium is AMC, asset management company, which will be over and above ARC. So ARC does the balance sheet part of it. It takes away those loans from banks, keeps on its balance sheet, and then delegates the task to manage these assets, operate these assets to a expert pool of people, which will be on the role of AMC, asset management company. So this is the model, ARC AMC model, combined model, to take care of assets which will become, I would say, financially viable and commercially viable over time, not today.
Sudhir, just one thing here. This model has been operating earlier also. Just wanted to the history. If you look at the recovery aspect, generally what happens if it goes for the RC kind of thing, banks get upfront 15%, and empirical evidences suggest that the maximum recovery is up to 30% of the assets being sold to the ARCs. How would this concept of bad bank would be different from the earlier concept, and what's the differentiator that the recovery would be higher? But how would the recovery be higher?
I don't think recovery would be higher. It's just that the noise over recovery being less will be lesser, because since public sector is money is being managed by public sector, the earlier charge that somebody is benefiting out of this mess will not be there. So politically it is more acceptable, right? Only time will take care of these assets. Nothing else is going to change it, right? The capacities which are being put through this ARC, only time will take care of it. So the only thing is that that CVC and CBI will be offshore back. That's what's going to happen.
That will be again nothing different.
Nothing significant in terms of revenue regulation. Yes, please. I think Anand sir has some question. He has raised hand.
Yeah, Sujit, nice deliberations. See, I was just thinking to put a question.
Sure.
Now government moved to popularize this bond markets extensively. These corporates raise funds for bonds to have cost benefit, and retailers also, shifting slowly to subscribe to these bonds, which is a yield effective. Now, in such a scenario, in down the lane, say 2-3 years, so what effect it will have in the bank's balance sheet, both on retail side and asset side? See, when retailers are shifting to bond market, then it will have an effect on my retail side. And corporates issuing these bonds, it will have an effect on my asset side. So, where do we stand 2-3 years down the lane?
Very good question. I think very depth answer is required. I will do my best. See, what is happening on retail side is it's given just another alternative. You already have retail investors avenue to invest in government bonds, but via mutual funds. So institutional players were pooling money from retailers, and then they were investing into government bonds. What Reserve Bank says that you give another option, you can directly come into. It is hoping that a good percentage of extra borrowing will be financed through this route, but overall net basis, the share of government bonds as a part of household portfolio will not go change.
Okay.
I don't think that percentage is going to change significantly. If you have the household savings of let's say 10% of GDP, of that financial assets which are in government securities, that share will remain where it is. So that is not a big worry. For banks, how could it be challenged? There have been competing products. You have this PPF, you have this senior citizen savings certificate, you have this bonds also. So our customer, why they keep money with us has a very different logic. It doesn't have to do with government borrowing, right? The only thing that will differentiate us henceforth is that we can't be pretty sure that this money will stay with us forever, because earlier those choices were not that significant. So that will definitely impact us, but not at a scale that that it appears, right? And on asset side, I'm more actually concerned because when you have the corporate bonds coming up in a significant way, the borrowing from corporate lending banks will go down for sure. And that was actually intent also. When Reserve Bank of India came with this large exposure framework, the very intent was that the reliance on banks to fund corporate projects should come down. So the policy itself wants government itself wants banks not to do as much they would have done.
Okay.
Right. Okay. So you have to identify a niche. You have to say that beyond this scope I won't be pursuing these opportunities. But you have to be very smart in choosing those opportunities. At what price you are choosing, because you earlier too much competed. The story of BPLR, the story of Base Tech and BCLR. What happened? We outcompeted each other and benefited somebody else. There we have to be very smart.
Okay. Thank you.
We have one more slide, iPhone. Please. Any questions for us, sir?
Sujit, if may I ask one, Vishweshwaran here. Yes. I think in the recent RBI's announcement, they have said that even retailers will be permitted to do the bond transactions through them directly. The initial thought was, why do you want to create this one? Already you have a well-set infrastructure in terms of NSE and the related DMAT and other thing. Why they are reinventing the wheel? What are your thoughts?
It's foolish. It's foolish. To be very honest, it's a foolish thing to do. But then when government does it, you have to justify it. There's no logic.
Then justify.
They themselves say that no other significant country has done it. We are doing. But why are you doing? If it is such a smart thing, others would be also doing it actively. Why to reinvent the wheel? There is no justification, sir. I completely agree with you. They are reinventing the wheel.
Yeah,
Thankfully, I'm not on RBI. Yes, sir.
Sujitji, one question. In case of bad bank, as per the past experience of the entire banking sector, including our bank, the ARC already exists in the market since a long time. And earlier, the transfer or assignment of the asset to ARC is just like which are follow in the bad bank, keep 15% cash and 85 as SR. And as per the past experience of the existing ERC, the recovery from SR is not well to the banks, and that's why most of the peer bank, including our bank, not selling the asset as on debt to ERC as on SR basis. As per our bank, we are last 4 years assignment of debt or sell our asset to the ERC only fully cash basis, and that is followed by the other peer bank also. So as per the past experience, the assignment of NPA to the ERC based on cash as well as SR, not recovery as per expectation of the bank. So just not the creation of the bad bank, only our bad bank created by the so many PSU or the other sector only PP models. So how to change our scenario for recovery if the past experience is SR is not recoverable, by the bank, then in the future.
I got your point, sir. I got your point, sir. There is a saying that better late than never. This ARC AMC, which is being announced in 2021, should have come somewhere in 2015-16 when this insolvency system was not invented. When IBC was not there, it is then that you needed this thing. But the problem was that at what price you would transfer those assets. The biggest noise is about haircut. People say that it's not haircut, you go bald. Right? And that time banks were not having the provisions adequate enough to take that kind of a haircut, because you knew that these assets have deteriorated, right? So from 2016 you have come to 2021. Over the 5-year period, what has happened that those assets which we identified as bad, we have provided almost fully, right? The point is at what value you still want to discharge. If it is on public sector balancing, you will be subjected to further questions, right? It's not just commercial decisions which take precedence. We have to also manage optics, and that the optics is what prevents us from taking hard calls. And this is the reason that has not happened. Why we don't sell to ARCs? Because ARCs are interested. Other things that we don't agree on the price at which transfer will happen. If you sell it to public sector entity, then that assurance is there. No? It's just kind of, when I invested in Union Bank of India and the share goes down from 150 to 25 rupees, still LIC will not be proved that we have made a bad judgment. Right? But if some private sector guys had done it, they would have been fired.
But the recovery
you are asking that how it will be beneficial to bank?
No. Recovery from ASR, recovery from ASR signed by the ARC to bank is not up to the mark as per past experience.
Exactly, sir. I'm telling you that this ARC will not have a very high number of high percentage of recovery. If you are hoping that having a public sector ARC will give you better recovery numbers, you are mistaken. This is not to address that aspect. What I see, this is just to say, make sure that come on, guys, you have done enough. Right, let's unburden you to do more profitable business. You lend it again. You don't get stuck with these projects on your balance sheet. I transfer part of it, right? So you have lesser worries to bother about. That's it. Don't expect that these. Yes, sir.
Sujit Mukkal here.
Yes, sir.
Can I intervene on this? Something?
Yes, please.
My thoughts about this kind of larger scale may be the perspective.
Yeah, of course. It's 2 trillion. 2.5 trillion that we are looking at. And this is mostly financed by public sector.
Only thing I was worried about the capital requirements of these bad banks.
So if you look at the overall numbers, if you have to take 2.5 trillion of assets on bad bank balance sheet, for 15% cash, you need at least 35 to 40,000 crore. Now that is the number that we have to look at. How it will come, in what stages it will flow to bad bank balance sheet, only time will tell.
That was good deliberations, I think. Sujit has covered a lot of points for us.
Sujit, if I can just take you to another subject, a bit different. We have been talking a lot of this. One is, recently there has been, I read in the news that there is a PL against RBI. The concept is different, but basically the question is that they have failed to deliver to prevent a lot of failures like banks and other institutions, PMC, IL&FS, DLF, Divan Housing, and even Yes Bank, another Lakshmi Bank, Dhanlakshmi Bank. So the list is even big. So the basic question is, what is that was missing, or what could be done differently? What is a better place to be?
It's a kind of police and thief kind of thing. You can never have a situation where there will not be any thieves in the country, and you can never have a police efficiency which will make you theft free. It's just you have to ensure that a larger population is able to do with its routine without being disrupted at a very unique way. So whether Reserve Bank can actually avoid or prevent failures going forward, it can minimize degree. It cannot eliminate the risk. So that will be there. Failures will be there. That's why there will be relevance for regulators also, right? And as for your question, I think the mood question I missed to deliberate on, that you also have this working group recommendation on entry of corporates into banking, and the rationale was the same. People attacked this recommendation saying that, come on, you have bank failures in public sector, then you also have the private sector. So private sector is not above the water. Why don't you question them? Why don't you learn from them? And then so somewhere regulation is where need to be fixed rather than having a ownership being fixed. So I agree with you, sir. Regulation has a much bigger role to ensure the system is efficient, the deposit interest is being protected, and financial intermediation happens. That is very important. But this question is important: whether corporate should be allowed to fund India's growth. My individual view is that India's bank credit to GDP is too low. Around 50 to 55% of GDP is too low compared to our aspiration. If you want to be a $5 trillion economy, if you want to be the third largest in the world, if you have the banking system which is among the top 100 representation is quite higher, we still have just one State Bank of India ranking at 55. Then we need more equity, we need more capital, we need risk-taking capital. And where else to look at? Not private sector. I mean, government at the end of the day is limited. You have 85 to 90% public debt. Your borrowing cost, you servicing that borrowing, it takes about 30% of your taxes, every year taxes. In terms of GDP, it's about 3.5% of GDP. So there are constraints. Government cannot just go on about doing everything. It can't capitalize banks to a level that it funds all the aspiration. You need more banks. That is for certain. There is no denial. Whether what kind of governance structures need to be put in place so that private players, they usually don't do those foul plays which is expected of them because of profit motive. That is the centrality of decisions. I think Reserve Bank, DFS, or whosoever is in the system, they are pretty aware that we need more banks. Corporates are the future, but what regulations to be put forth, that need to be protected. So. So have we reached to the level? Okay, I think there are no further questions.
Yeah, the questions are closed, and because we are all awestruck. Thanks for all the effort you have been taking, and I hope that one or two members will be contacting you in person also to get the updates.
Yes.
And nonetheless, it is very wonderful. On behalf of everybody present, I would like to thank you for the initiative and the effort, and also the insights you have given. Very helpful and much thanks. Much appreciated. All the best.
Thank you, sir. Thank you, sir.
Thank you, Sujit. Thanks a lot for the nice initiative and a lot of thoughtful deliberations. Really, it matters a lot. Thank you.
Thank you, sir. This is a very healthy discussion.
It was really nice to hear from you, and we are very thankful to you. Thank you.
Thank you, sir.
Thank you, Sujit.
Thank you, sir.
Bye.
Thank you so much.
Thank you, Sujit.
For taking your time.
On your special day. Thanks a lot.
Thank you, sir. Thank you so much. All the best to everyone. Hope we have more senior executives who have
I think,
taken the bank to new heights.
Sujit, we can have many more, like this. because we have holidays in between.
Yes, yes, I'm available, sir. I'm available. And it would be a good idea actually. If somebody have some
Yeah,
questions and they share with me, I can
Yeah.
have 5-10 questions and then we can have half an hour, 1 hour session.
So definitely we
Yes,
can
sir.
think more of a two-way communication. Okay. So today you have provided all we all give our input. So whatever this two-way
In
communication.
that case, Sujit, I will give you
Sir.
some food for thought for the next interaction we might have. Would be like
Perfect, sir.
some walkthrough on these major incidents that happen. Like as I told you that Divan Housing, IL&FS, say like Abhi, Yes Bank, even the latest one, even the latest cooperative bank. I'm just missing the name of it. Other than PMC, there was one more, right?
You continue.
I think the
Some
Punjab,
sort of a high level update on that. Not exactly the basics, but in terms of what can be the lesson learned for us into the whole thing. Probably, if not on a personal point of view, at least from an interview point of view.
Yes, yes, surely.
So probably this is some food for thought.
Perfect, sir.
So next time when we schedule any meeting like this, I think let us make some preparations also, so that we can add a lot of value to the
Yes,
deliberations
yes.
also. I think Sujit will be the anchor. I think
Yeah, perfect, sir.
he
More
can
than
give
happy to.
a lot of inputs to us. He will be the sitting in a prime place, and he can navigate the deliberations. And wherever if somebody wants an additional information or any extra output or something like that, so Sujit can definitely intervene and coordinate with the speakers. So let us talk out, Sujit. Okay. So thank you so much.
In terms of Sujit, one more point also. In terms of link, I think we can save ourselves of this 40 minutes. So there are two options. Either if you let me know, I'm ready to share a Teams invite so that can be shared and any number of people can come and there's not be any time
And even
time restrictions. Artificial time
Yes.
Even from my side also, Vish, actually, see, if you want to have an extended time, definitely we can organize for it. Okay, either Microsoft Teams or the same. So let us not have any bar on this time restriction. So as long as